Imagine a company so powerful that its assets are larger than the entire economy of India. A single entity that holds a stake in nearly every major corporation you interact with daily, from the media you consume to the products you buy. This isn't science fiction, it's the reality of a financial giant you've likely never heard of, a shadow empire that operates in plain sight, quietly shaping the world. I'm talking about BlackRock. With over $9.4 trillion in managed assets, only the economies of the USA and China are larger. To put that in perspective, if BlackRock were a country, it would be the third richest nation on Earth. So, if they're this powerful, why aren't they a household name like Apple or Google? And more importantly, how did a company with such a humble beginning become the most influential and feared player in global finance? To understand the genesis of this financial behemoth, we have to go back to the man who founded it. A man driven by both ambition and a monumental failure. His name is Larry Fink, and in the early 1980s he was a rising star on Wall Street, a financial prodigy at the investment bank First Boston. He was the go-to guy for a groundbreaking financial product he helped pioneer, mortgage-backed securities. These were complex bundles of home loans that could be bought and sold like stocks, a lucrative innovation that was revolutionizing the market. Fink was a master of his craft, known for his ability to see opportunities where others saw only risk. His charisma and success were a legend on the trading floor. But in the high-stakes world of finance, hubris can be a fatal flaw. In 1986, his world came crashing down. Larry Fink made a prediction that went horribly wrong. He bet on the future direction of interest rates, a massive, leveraged wager that was supposed to make the bank a fortune. Instead, the market moved against him, and in a single, gut-wrenching day, his team lost over $100 million. It was a catastrophic failure, a professional humiliation that sent shockwaves through the industry. It cost him his job and severely damaged his reputation. He was out of the game, a man who had been a symbol of success, now a cautionary tale of a Wall Street blunder. But for Larry Fink, this wasn't the end, it was the beginning. This devastating loss became the turning point, the crucible from which his greatest ambition was forged. He realized that the one thing missing from the financial world wasn't more clever traders or more complex products. It was proper risk management. It was a lesson he would never forget, and it became the foundational principle for his next venture. Out of work and determined to prove himself, Fink approached his former colleague, a man named Stephen A. Schwartzman, who had just founded a small but ambitious new private equity firm called the Blackstone Group. Fink came to him with an idea, to build a new kind of company, not just focused on making money, but on protecting it. A company built on the foundation of risk analysis, using sophisticated models to predict and mitigate potential losses. Schwartzman was intrigued. He saw the potential in Fink's vision and agreed to a partnership. In 1988, they founded a new company, initially named Blackstone Financial Management. The investment was small, just $5 million from the Blackstone Group for a 50% stake, but what they lacked in capital, they made up for in a revolutionary new approach. In the world of finance, where traders often operated on gut feelings and aggressive speculation, Fink's new company was a quiet anomaly. They were the engineers of the financial world, focused on data, on mathematical models, and on understanding risk with a precision that was unheard of at the time. Their motto could have been, "We don't just want to make you money, we want to make sure you never lose it." This was a powerful, comforting message to institutional investors, and within 6 months the company was managing a staggering $2.7 billion in assets. Their growth was explosive, a testament to the pent-up demand for their unique brand of financial security. But a new challenge soon arose. As the company grew, a fundamental difference in vision emerged between Fink and Schwartzman. Schwartzman's Blackstone was a private equity firm that thrived on aggressive, high-risk deals. Fink's Blackstone Financial Management was the very opposite, a conservative, risk-averse asset manager. Their names were linked, but their philosophies were diverging. It was a partnership destined to split. In 1994, Schwartzman sold his stake in the company back to Fink and his partners for a remarkable $240 million. The company was now fully independent, and with its new independence came a new name, BlackRock. It was a portmanteau of the two former partners' names, a symbolic nod to its origins, but now standing as a completely separate entity. Now on its own, BlackRock was ready for its meteoric rise. It went public in 1999 with a valuation of $900 million, a massive number for a company that was still relatively unknown. But the public offering was just the beginning. The foundation of BlackRock's success wasn't just its people, it was a piece of technology, an all-seeing financial eye that would come to dominate the entire industry. This was Aladdin. Aladdin is not a magical lamp. It is an acronym for Asset, Liability, and Debt and Derivative Investment Network. It is, at its core, a sophisticated software system designed to analyze and manage risk across entire portfolios. While other firms were still using spreadsheets and guesswork, BlackRock was building a supercomputer for finance. Aladdin could model trillions of dollars in assets, predict how a market crash would affect a portfolio, and find hidden risks that no human could possibly see. It was the ultimate financial fortress. But the true genius of BlackRock was that they didn't just use Aladdin for themselves, they started selling it. They licensed the software to other banks, pension funds, insurance companies, and even sovereign wealth funds. And that is how BlackRock's influence quietly began to spread. When a major bank uses Aladdin, BlackRock is not just providing a service, they are gaining unparalleled insight into that bank's operations. They can see what's in their portfolios, understand their risk exposure, and in a way, peer into the very heart of their business. By the mid-2000s, BlackRock was no longer just an asset manager. It was a central nervous system for the global financial world. And then came the ultimate test. In 2008, the global financial system nearly collapsed under the weight of the same kind of mortgage-backed securities that had humbled Larry Fink decades earlier. As banks failed and markets froze, the US government was faced with an impossible task: to untangle a spiderweb of trillions of dollars in toxic assets. The crisis was too complex, too vast, for any single government agency to handle. So, who did they call? They called BlackRock. They called the company that had built its entire business on the principle of risk management. The company with the all-seeing software system, Aladdin. BlackRock was hired to analyze and manage the toxic assets of banks that had been deemed too big to fail. They were the cleanup crew for the world's financial mess. By helping the government, BlackRock didn't just earn a massive payday. They cemented their reputation as a trusted, indispensable partner to the very governments that regulate the world's economy. They became the go-to firm, the one you call when the entire system is on the brink of collapse. Today, BlackRock's influence extends far beyond crisis management. It is a quiet, powerful presence in almost every aspect of your life. As the world's largest investment firm, BlackRock holds significant stakes in nearly every major company you can name. They are a top shareholder in Apple and Microsoft, in Amazon and Alphabet, Google's parent company. They own pieces of your favorite media outlets from Disney and Comcast to Fox and News Corp. They own pieces of the companies that make your food, your cars, your clothes, and your medicine. They are a top shareholder in Apple and Microsoft, in Amazon and Alphabet, Google's parent company. They own pieces of your favorite media outlets from Disney and Comcast to Fox and News Corp. But what does this mean? It's not just about ownership, it's about influence. BlackRock's power isn't in day-to-day management, it's in what's known as proxy voting. When you own a significant number of shares in a company, you get to vote on its leadership, its policies, and its strategic direction. With its vast holdings, BlackRock has become a kingmaker. Its votes can influence who sits on a company's board of directors, whether a company adopts certain environmental policies, or if a merger goes through. This gives BlackRock an unparalleled ability to shape corporate America from the inside out. Critics argue that this creates a dangerous network of interlocking ownership. BlackRock is not just a shareholder in competing companies, they are often a top shareholder in both. For example, they hold a significant stake in both Coca-Cola and Pepsi. They own parts of competing banks, competing airlines, and competing pharmaceutical companies. Does this create an incentive for these companies to compete less aggressively? Does it lead to an unspoken, centralized control of the market? The questions are profound and the answers are deeply unsettling. And their power is not limited to the private sector. BlackRock also manages pension funds for millions of people, and advises central banks and governments around the world. In essence, they are entrusted with the financial security of entire nations. They are a critical advisor to the governments that are supposed to be regulating them. If the 2008 crisis proved BlackRock's worth, the 2020 pandemic confirmed their indispensability. As the global economy went into lockdown, bond markets began to freeze up, threatening to cause a second financial collapse. Once again, the U.S. Federal Reserve turned to BlackRock. The Fed hired them to run a massive program to buy up corporate bonds and stabilize the markets. It was a program of unprecedented scale, and once again, BlackRock was in the driver's seat. This decision, to give such immense power and responsibility to a private company, was not without controversy. Critics argued that the Federal Reserve was blurring the line between public authority and private interest. Was it appropriate for a government agency to essentially deputize the world's largest asset manager? For BlackRock, however, it was another moment of triumph. Their role in the crisis solidified their position as a shadow government of sorts, an entity that, in moments of global peril, is considered too essential to ignore. Today, BlackRock's influence extends far beyond crisis management. It is a quiet, powerful presence in almost every aspect of your life. So, we are left with the central mystery. If BlackRock is so powerful, why don't we see them on the news? The video you are watching now is one of the few pieces of content that attempts to pull back the curtain on their operations. But for a company that is so integral to global finance, their public profile is remarkably low. Some argue this is deliberate. The video suggests that BlackRock prefers to stay out of the spotlight because it controls a significant portion of the very media that would cover them. They hold shares in major media companies, and their power is so vast that no news organization would dare to bite the hand that, in some way, feeds them. This isn't a conspiracy theory, it's a simple observation of the financial realities of corporate ownership. If you own a part of the media, you have a stake in its success, and a conflict of interest that could influence what gets reported and what doesn't. But this isn't just about control. It's about a new form of power. Unlike the robber barons of the past, who were focused on monopolies and cornering markets, BlackRock's power lies in diversification. They don't want to own just one railroad, they want to own a piece of every railroad, every plane, every shipping company. Their goal is not to control one market, but to be a part of the entire global economic system. In a crisis, they are not a target. They are a safe harbor, a stable force that governments turn to for guidance. If the 2008 crisis proved BlackRock's worth, the 2020 pandemic confirmed their indispensability. As the global economy went into lockdown, bond markets began to freeze up, threatening to cause a second financial collapse. Once again, the U.S. Federal Reserve turned to BlackRock. The Fed hired them to run a massive program to buy up corporate bonds and stabilize the markets. It was a program of unprecedented scale, and once again, BlackRock was in the driver's seat. This decision to give such immense power and responsibility to a private company was not without controversy. Critics argued that the Federal Reserve was blurring the line between public authority and private interest. Was it appropriate for a government agency to essentially deputize the world's largest asset manager? For BlackRock, however, it was another moment of triumph. Their role in the crisis solidified their position as a shadow government of sorts, an entity that, in moments of global peril, is considered too essential to ignore. So, we are left with the central mystery. If BlackRock is so powerful, why don't we see them on the news? The video you are watching now is one of the few pieces of content that attempts to pull back the curtain on their operations. But for a company that is so integral to global finance, their public profile is remarkably low. Some argue this is deliberate. The video suggests that BlackRock prefers to stay out of the spotlight because it controls a significant portion of the very media that would cover them. They hold shares in major media companies, and their power is so vast that no news organization would dare to bite the hand that, in some way, feeds them. This isn't a conspiracy theory, it's a simple observation of the financial realities of corporate ownership. If you own a part of the media, you have a stake in its success, and a conflict of interest that could influence what gets reported and what doesn't. We started this journey with a single man's failure, and have ended it with the story of a trillion-dollar empire. From the ashes of a $100 million loss, Larry Fink created a company that has, in a way, conquered the financial world. It is a company built on a paradox. To mitigate risk, you must first centralize control. But as BlackRock's power grows, so do the questions. Is this level of centralized power a good thing? Does it bring stability to an increasingly volatile world, or does it create a single point of failure that could one day bring the entire system down? Does the world's reliance on BlackRock's Aladdin system make us all safer, or does it make us vulnerable to the decisions of a single private entity? The answer to these questions will define the future of finance, and perhaps the future of our world. BlackRock is not just a company. It is a new kind of power, a quiet, unseen force that operates in the shadows, and it is a force that, whether you realize it or not, has a say in your life every single day.